Hello and welcome to the first module of Fundamentals of Financial Management. This session will cover the topics of income and expense tracking, understanding loans, and banking basics. You will develop skills to help you understand money better. To get started, let's think about what is one financial goal that you want to accomplish by the end of the year. Let's write your answer on a piece of paper and we'll come back to this by the end of the literacy class. Feel free to pause the video to write your answer. Now let's talk about the ways that you can earn an income. First and foremost would be through the direct source, having a primary job. This is where you would have a full-time position to earn an income. Some of these include working as a teacher, customer service representative, accountant, therapist, carpenter, and the list continues on. There is financial support available through government programs. These include SNAP, TANF, alongside food and gas vouchers. SNAP is a supplemental nutrition assistance program. The government provides monthly funds to help you buy groceries. To apply, visit your local food bank or SNAP office to see if you are eligible. TANF is the temporary assistance for needy families. This program helps families with children who cannot provide basic needs. It funds food, housing, home energy, and child care. To apply, you can visit your local Department of Social Services office or apply online through your state's website. There are food and gas vouchers available. Food vouchers allow individuals to purchase food from the local grocery store. As for gas vouchers, they are funds that help you pay for gas or obtain a reduced fare ticket for the bus system. Good Neighbor Assistance, Emergency Assistance, our office provides food and gas vouchers for those who may need it. Another source of money would be through the disability income provided by the government program. These are Social Security disability insurance and the supplemental security income. Social Security disability insurance provides monthly payments to individuals who have a disability that stops their ability to work. In order to be eligible for this program, one must have a disability or a blindness and enough work history. Supplementary security income provides monthly payments to people who are older adults and disabled and have little to no income. In order to be eligible, one must have little to no income, little to no resources, and have one of the following: a disability, blindness, or 65 years and older. To apply, you can call their number and make an appointment. There are other ways to obtain an income. We're going to focus on side hustles. These include donating plasma, cleaning houses, babysitting, selling old items, selling crafts, dog walking, mowing lawns, filling out online surveys, and improving skills that allow for more opportunities to be accessible to you. Let's move to what are fixed and variable expenses. Fixed expenses are money paid in the same amount from month to month. These may include rent or mortgage payments, student loan payments, and debt repayments. Variable expenses can change month to month and have different costs. Some examples include groceries, utility payments, medical payments, or personal care. We'll now be moving towards the topic of loans. Loans are money borrowed from the bank or other financial institution that must be paid back later. We'll be going over some basic terminology for a better understanding. In order to borrow a loan, one must have a credit score. Credit score is a major component of whether you qualify for a loan and what interest rate it will be at. The credit score can range from 300 to 850. A higher score indicates that you will have a good credit and that you will likely get a loan. A lower score will lead you having a difficult time getting a hold of a loan, and if you do get a loan, the interest rate will be higher. In order to build your credit or have a good credit score, some of these variables contribute to you increasing or improving your credit score, which are paying your bills on time, paying off any debt that you may have, or securing your credit card and using it responsibly. The borrower is the responsible party in repaying the loan or debt. The principal amount is the initial amount that you are borrowing. This amount does not include fees or interest rates or the APR. With loans, there is an APR. APR stands for annual percentage rate. This is the yearly interest rate on the money that you are borrowing, including charges and fees. There is also installment loan, which are regularly monthly payments of the loan. It is important to note that longer installment periods, such as 84 months, have higher amounts of interest being paid over time, with the upside of lower monthly payments. On the other hand, if you have a shorter installment loan period, such as 24 months, there is less interest paid over time, but The downside is having higher monthly payments. APR can be a bit difficult to follow, so let me give you an example of Sarah. This is Sarah. Sarah wants to buy a moped to get to her job. She estimates that she needs $1,000 to buy a moped and register it. She decides to take out a $1,000 loan to pay for a moped. The bank says that they will give her a $1,000 loan with a 10% APR. This means that her bank is taking 10% annually because of the interest and other fees. To figure out the APR in dollar amount, you would take the estimate amount of $1,000 and multiply by 10% to get to $100. This means that yearly $100 will be charged to you for the convenience of the loan. It is important to pay off your loan as soon as possible, as the APR can quickly add up and make the small loan quite large. In addition, most loans come with a service fee. This means that you will be paying a specified amount on top of what you will be paying with the APR. Now let's talk about student loans. Student loans are the money that you will be borrowing in order to go to higher education. There are two types of loan, subsidized and unsubsidized. Subsidized are where interest does not start until 6 months after graduation. Unsubsidized loans have interest that start as soon as the money is borrowed. There are relief programs available. Relief programs allow borrowers to manage and repay their debt, and there are two types. We have loan forgiveness programs that aim to forgive the remaining balance on the direct loans depending on how long a person has been making the payments. In certain circumstances, some programs are professionally field related, such as teacher loan forgiveness or nurses. There's loan discharge, which varies in different situations. For example, there's total and permanent disability, which cancels federal student loans if the borrower is unable to work due to permanent disability. And there's also death discharge, where federal student loans are discharged if the borrower dies. Personal loans are where you may borrow money for anything. These types of loans are more flexible, but they have higher fees, which are often borrowed through the bank. For mortgage loans, they're used to purchase a home or property. The money will be paid through the monthly payments over a fixed period of time with interest. It is important to note that the debt is tied to the home. This means that if you are unable to pay recurring payments toward the mortgage loans, the lender will take the home away. Auto loans are for motorized vehicles, which include cars and motorcycles. They are promotional offers for newer vehicles, which may state they have a 0% down financing or 0% interest rate. However, there may be drawbacks to these promotional offers, so let's break them down. For instance, if we have a 0% down financing, it indicates that you do not have to make an upfront down payment, with the downside of having a higher interest rate. On the other hand, if there is a 0% interest rate for a new vehicle, this means that there is no interest rate going towards the vehicle for a given amount of time, but again, the downside is having to make a larger down payment. Payday loans are one of the types of loans. It is best to avoid payday loans as it has more negatives than positives. Although there may be a quick way to get your money before your pay period, they do have daily interest rate. Daily interest rates are important to know as they are compounding, meaning that the interest rates builds on top of the principal amount every single day, leading to higher and higher balances owed to the lenders. Now let's talk about the basics of banking. There are many types of banking accounts, starting off with a checking account, a savings account, and a money market account. These accounts are set up in order for you to place your money in a safe place and that you are able to easily access it, whether that be through online banking on your phone, through your debit card, or going to the bank. A checking account is free to open. Although many banks may not have a minimum to open it, a majority do require a minimum to maintain the account. A checking account comes with a debit card. A debit card allows you to access your checking account funds to make purchases, pay your bills, or withdraw money from the ATM. There is no interest on the debit card nor keeping your money in the checking account. The only source of money coming in would be from your income. Another important note with a checking account is the term overdraft. Overdraft is spending more money than what you have in your account. This puts a negative balance on your account. You can think of the bank making the transaction for you, but with a fee that you would have to pay back on top of the overdraft fee. To protect yourself from overdrafting, always check how much you have and turn on overdraft protection. With overdraft protection, the bank can decline the transaction or link the checking account to a savings account or a credit card to make up for the insufficient funds. This would be up to your decision. A savings account is also free to open. Usually people open a savings account at the same time as their checking account. A savings account earns extremely low interest. It acts as an emergency fund or savings account for a specific goal for individuals. Thus, there is no card associated with this account. In order to place money into this savings, transfers can be made through the checking account to the savings account or vice versa if you do not have enough money in your checking account. There is no limit on how many transfers or withdrawals you are able to make with this account. A money market account is a type of savings account. This type of account requires individuals to have a minimum balance to open it, but it has higher interest rates. What this means is that when you place your money into this type of account, you're slowly building your money with the bank as the bank is giving you money to have it stored at their financial institution. You are limited with how many withdrawals you are able to make, but this is great for short-term goals. Now let's talk about checks. They are associated with your checking account and therefore called a check. Checks can be ordered from your bank, typically with a small charge. Checks can be thought as a physical, handwritten money that you will be giving to someone or an organization. On the screen, we have an example of what a check looks like. Now let's go over these parts. So first off, we have number 1, which is your personal information. This is where your name and your address will be. Please make sure that this part of your information is correct. Now moving to the second part is the payee line. This is whom the money will be going towards. Here you would write their name or their organization. 3 is the date line. Please make sure to write the current date on the date line. Number 4 is the check number, which identifies the specific check within the checkbook. It can also be used for record keeping and for bank statements. Number 5 is the bank fractional number, which is used to identify the bank where the money will be taken from. 6 is the dollar box, where you would write how much in numerical value you are paying. 7 is the most important part. This is the signature line, which is where you will sign your name. A check will not be valid until you sign it. Number 8 is the account number, which identifies your specific checking account. Number 9 is the ABA routing number, or sometimes just the routing number. It is used to identify the financial institutions in the United States. 10 is the memo line, which is optional, but you would briefly describe what the check is being written for. Number 11 is the amount of check that is written out based on the dollar box. You will spell it out in words, including the cents as fractions. Now let's talk about safeguarding your information. Your bank may request documents such as your ID or your social security number during the process of opening a bank account with them. Please do keep in mind to not share your social security number, your debit card PIN, or any of your bank's account information with anyone else. It is important to note that if you think a bank is calling you, they will not ask you for your PIN, your passwords, or any kind of sensitive information. It is best to hang up the call and call your bank directly on the back of your debit card or visit your local bank to confirm details regarding the call. Thank you for joining me on this first module. I hope everyone learned a lot and that you were able to take this information and use it in your real life. If you have any questions, feel free to reach us through email or in the comment section below. I'll see you in the next module. Take care.